Those are the two kind of trade news elements that are here. Bottom line, the moves haven't been all that big. They've been sizable, but we haven't seen more than a percent move based on based on the trade news factors here. So a little more tame than what we've seen other things in the past, but we're also looking at a market that's near all-time highs, right? And it's one where the market's very, very close to those all-time highs, and we've talked about that quite a bit. But then we also had this little bump right here. Let me change the color on that. This little bump right here, and this is on the ECB, the European Central Bank. Now, the European Central Bank announced their policy decision this morning and came out and basically said, hey, we're going to take the deposit rate down to negative 0.5%. So they made it more negative. And they announced an open-ended quantitative easing program of bond buying where they're going to buy $20 billion worth a month with no end date scheduled. Yep, the fears that happened. If you were trading back in 2009, 2010, 2011, into 2012, when everyone's worried about what is quantitative easing going to do long term to the economy, to central bank action, is it just going to turn into central banks having permanent quantitative easing forever, never getting back to what things were? The answer is yeah. Yeah, absolutely. There were so many disaster scenarios, for if that happened. But bottom line is we continue to see central banks have more pressure to ease than to tighten. And, they basically can print money. So they can leave rates negative. They can basically pay people to borrow money and, go and print as much money as is needed to be lended. So that's what we are seeing. And, we saw a couple changes in things with that. We saw a little bit of we saw the U.S. dollar continue higher initially. It has pulled on back and is trading lower here today, which is really interesting. And the euro is trading higher here. But gold, we saw a small snapback in gold here this morning, which is being erased. We saw, bonds here in the U.S., the TLT, have a sharp uptick, and that is being erased. So, a lot of the initial reaction stuff to the ECB is being erased here. So those are, the major news events that are going on here this morning. Now, for the challenge, we have 237 crossovers out there this morning. One on Coca-Cola, which is not a signal the way it sits right now, and the other on Procter & Gamble. And you'll notice these are very similar charts and price action. Procter & Gamble is not a signal as it sits right now, but could be a signal here by the end of the day. We'll see. This is one that a couple days ago had a downside 3-7 crossover, but was not a bearish signal. Now has this kind of 3-7 crossover. I'm very interested to see how the consolidation risk component plays out by the end of the day. But it is one that is not signaling as it sits right now. Okay, so nothing to get into here for the challenge, and I'll speak to a bunch of challenge stuff here in just a moment. But before we do that, do want to go back to a little bit on the news front. Steven Mnuchin, U.S. Treasury Secretary, this morning came out and basically said 50-year bonds are coming probably next year. We have the 2-year and the 10-year and the 20-year and the 30-year. Well, here comes the 50-year, and around the corner is going to be the 100-year. And, we are seeing economic changes in action, from a policy standpoint. Now, we also had U.S. President Trump tweeting. And as many of you know, I have an economics degree. And, is it worth much? Probably not. But one of my favorite economics courses that I took in college wasn't the supply versus demand and the Laffer curves and all the all the mathematics of things, because bottom line is they all kept real world variables constant, and so you're sitting there going, wait a minute, this variable is never constant, but yet we're doing all this work that if it were, what would happen? For what? It kind of drove me nuts. But I really enjoyed the economic theory classes, the ones that were on economic thought, and how different economists over the course of time thought about things, and seeing that evolution, from Keynesian economics and all the way back to John Smith, and just these major figures over history that had a great influence on economic thought, and really looking at how their thought processes changed over time, because the reality is they changed, and they changed a lot. One of the things that I think could be added as a economics class these days is, hey, you know what? The whole class on economics is about U.S. President Trump's Twitter account. Now, I'm not talking from a political standpoint, or love President Trump or hate President Trump or anything like that. I'm just talking purely from an economic standpoint, right? And so, tweets like "we can't beat him, so let's impeach him." Who cares? Yeah, that has nothing to do, with the economics. But when we come into his Twitter account, very often we're seeing stuff like this. European Central Bank acting quickly, cutting rates 10 basis points. They are trying and succeeding in depreciating the euro against a very strong dollar, hurting U.S. exports, and the Fed sits and sits and sits. They get paid to borrow money while we are paying interest, right? And really just kind of, what are all the, economic thought processes, and how does this affect things, in the real world going forward? And there's a lot of this, that we see week in and week out in U.S. President Trump's, Twitter account. And one thing about economic theory and thought is it's constantly changing, and it's never one of those things where you go, well, this is right and this is wrong, right? We have seen some disastrous economic policy decisions made over the course of time that turned out to be really good because of some other variable that stepped in and overcame it. We have seen some really bad policy only intensify economic downturns, like the Great Depression, where the authorities thought, well, you know what, we're going into this depression. Let's cut money supply, and that'll help. Well, no, wrong theory. That only intensified it, and so officials have learned, and what do they do on recessions? They make money easier. They increase the money pool. So we see this evolution, and we are in right now an evolutionary period, and one that has some brand new stuff going on, right? So some really just exciting brand new stuff, and how is that going to affect things, and how is that going to change things in the market? Well, have we ever seen, and this is, and I'm going to start going into some of the questions that have come in over the last week, but this goes back to one that has come in, and it's, have we ever seen markets sitting near new highs with this many fears of economic recession? And it's a really good question. The answer is yes. We have seen markets sit near new highs and actually make new highs with fear of recession looming. Big one back here in 2007, right? And back in 2007, let's just come into 04, 01, 2007, 12/31, right? Back in 2007, there were big recessionary fears that started to come in, back here in the summertime. They started in May, June, came here in the summer. And what did we see? We saw markets go to new highs, right? But the economic data was eroding, and the market hit a new high, but the data was eroding, and the data continued to erode, and we saw the Fed cut rates a little bit, but the data kept eroding. And if we fast forward into 2008, one of the things we see is that the markets sell off into, some bank disasters with Bear Stearns and others, but rallies on back, then kind of just hangs out near these lows, and all of this is on recessionary fears that came in. But when the market broke down in September of 2008, the Lehman collapse, the market was nowhere near highs, right? If we zoom this back and zoom this out, we go back to 2007, when the market broke down right here in September of 2008, it was already almost 20% off of its highs. When we have seen some of the biggest economic downturns in history, we have rarely seen the market sitting at new highs. And I think that speaks volumes. I think that speaks volumes to what we are seeing. We saw a lot of economic concerns in 2013, 2014, 2016. And you know what? Market priced them in briefly for a few months and then pushed back to new highs. And magically, all the economic concerns, they dissipated. We didn't get that big bad downturn. Will we eventually? Yeah, probably. But when we have markets sitting at new highs, there's not a lot of precedence for breakdown. We can even go back to 1987. We could go back to we could even go back to the Great Depression and all of that. Most big drops, they have not happened off highs. When the market has hit new highs, regardless of the concerns, it has tended to continue to make new highs. And so, yes, there are recessionary concerns. Yes, we could talk about the bond market and money flowing out and in and all of that. But the reality is that there's still value in stocks. And while it may not be showing up on a PE ratio like they have historically, the value of stocks relative to bonds is crazy high, right? What are you gonna do? Go out and buy a bond that you have to pay money to own, right? Which is where bonds are going. You're gonna have to pay money to own bonds. So are you gonna buy bonds and pay money to own them? Or are you gonna go buy AT&T, you're going to go buy Verizon, you're going to go buy Pepsi, you're going to go buy at least something with a dividend. But if you're just going to be losing money buying bonds, what's the point, right? And so what does the Fed have to do? Central banks have to do, they have to step in, and they have to be the ones that, buy the debt, which is what they're doing. So anyway, that's rarely do we see a big economic meltdown off of new highs, and I can't think of even a good spot where we can say, yep, it happened. We saw a big meltdown off of new highs. I think the best arguments come in for last year, where we saw these new highs hit and then these really strong drops come in, rather than some sort of lower high come into play. But even then, we're not talking about big economic contraction or downturn. Okay, all right. The challenge. Okay, challenge here. Has had a lack of signals. We have not seen many signals come in here of late. It has been pretty dry. In fact, the entire challenge we've run at a lower rate of signals than what I have expected to see. Okay, now. Is it incredibly unusual given the past 3 years of data that we have? No, it's not. It's not incredibly unusual. It's not alarming. It's not even something that I'm looking at and going, man, I've got to alter and change and really react to it. Right, and I know there's some that they want more signals. Come on, it should be a signal a day. It should be 2-3 signals. Come on, let's do something where there's a lot more to trade. That's not what that's not what it's designed to do. And I will not make it that. Okay, but what the challenge trades are designed to do is they're designed to find when the odds are in our favor. One of my first experiences with a algorithm-driven trade signal was back in 2007. And this company that was working close to where I was, they came up with this software, and they came up with this signal that they called the U Delta. And this signal was a fantastic trade signal, and it was based off of pivot charts, right? And they brought us in, and those of you who remember Carl, they brought him in as well, and they wanted to see what traders thought of this signal, and they wanted us to take the signal and, start using it in our trading, and, how does it work and all of that. And it became quickly apparent that back-tested, the signal worked great. But in real time, no way. Also, was not applicable to options in any way, shape, or form. Because by the time you're into the option, out of the option, most options, even if the stock goes your way, were negative. It was one of those signals that was simply based on backtesting and had no forward relevance to it. And I know there's some that think, well, if you backtest it, it should work going forward. Well, that's just simply not the case. When you go to quant houses, when you look at the quantitative trading that happens in the market, the algorithmic trading that happens, you have teams of mathematicians that are constantly tweaking and adjusting the algorithms because market conditions are constantly being tweaked and adjusting. That room is open, right? That room is open for the challenge algorithm, and it is something that, we'll do over time and, have done even over developing it over the last three years. It's not something where it's going to be major tweaks and changes each challenge or each day or anything like that. There's just small, subtle optimization, types of things. That said, there's nothing about any of the data that we've had, this quarter that makes me want to do anything, drastic. As I've mentioned before, there will be a small change next challenge to the ATR method, and expanding this 5 days, step 5, up to 6 days. And I'll talk more about that as we go, but that's one of the small changes that will be made. But if I want more signals, right? If I want more signals, I know that each stock in here, and some have a little bit higher tendency, some a little lower tendency, but most of the stocks in here have 4 to 5 signals, really good signals a year. Sometimes all those signals come in a 3-month period, and then we go 9 months with no signals. Sometimes they're evenly spaced out. But most of them, it's 4 to 5 signals a year. So what do I know? I know that if I add more stocks into this, I'm going to get more signals. If I subtract stocks from them, I'm going to get fewer signals. You say, well, why not just add way more stocks into here? Well, because then we just have too many signals to deal with, and it's one of those where you're constantly getting in, getting out, and trying to have all money allocated at all times. It gets to be a lot, and we don't want that. But we also don't want long periods of pause. And as we went into this challenge, I increased the watch list, knowing summertime's a little bit lower. So let's, offset it, with that. Well, it hasn't offset it as much as I had thought it would, or as much as it has in the past. But, it's offset it some. Okay. Now, the signals here, and I kind of go back to this kind of U delta signal that was back tested and all of that. The signals here are not a back tested type of signal. There is some hindsight looking that the algorithm does to look at how the stock is done in certain situations. But what we're looking for very specifically is for a probability of moving 2 average true ranges. The U delta signal looked at, well, is this stock going to go up or down? Cared nothing about how much or how little, right? It just was, is this stock going to go up or down? That's it. The challenge algorithm is looking and saying, does this stock have a good chance of moving 2 average true ranges or more higher on a bull signal, or 2 average true ranges lower on a bear signal? Why? Because I have to apply options to it. In from an option standpoint, if I don't get movement, right? If we come into something like a Microsoft where we've had a signal, if we don't get movement, brutal. It can really affect the option in a very negative way. And so we have to have not only the odds of the stock moving in our direction high, which is fine, but we have to have the odds of a certain type of move elevated. When we go through a period of lack of signals, what that says basically is that we haven't had the odds strongly in our favor that we will see stronger moves, 2 average true ranges at least. It doesn't mean that we're not going to see that, right? In fact, if we come into a Caterpillar let's go to Caterpillar, right? If we come into Caterpillar had a 3-7 crossover right here, and I talked about it on this day. I said this has changed, right? I was short Caterpillar back in here. I got burned on a short on this move. And I mentioned on that day, hey, this is a very bullish move. It is not a challenge signal. Why? Why is it not a challenge signal? It's coming off of a new low. The way the challenge, looked at it, said, hey, consolidation risk is very high. And if we get a higher low, then we would have a decent challenge signal on the next 3-7 crossover. It hasn't had it. It's gone straight up. It did the exact same thing here in June, right? Now, if we look at other periods, it hasn't done the same thing. December had a nice little pullback and then moved higher. January, nice little pullback, then move higher. February, nice little pullback, then move higher, right? The norm is to have a nice little pullback and then move higher. The abnormal has been to just go vertical. Well, in this case, it's gone vertical, right? Where the U delta signal is trying to capture every move. The U delta, it's trying to capture, hey, what's the next up move? What's the next down move? What's the next up move? What's the next down move? And can do it in hindsight because it can just look at the best mathematical model to simulate what has happened, but doesn't work in the future. The challenge algorithm is very different. It is not looking for what's this stock going to do next. It has nothing to do with what is this stock going to do next. It is, has this stock done something that suggests that it can move 2 average true ranges higher from here? And what are the odds that happens? Because we can have it say, yes, you know what, there's a good chance that it moves 2 average true ranges higher, but you know what, the odds of it doing that are relatively small. Doesn't mean it's not going to happen. It just means the odds are not strong enough that if I do this consistently, if I buy Caterpillar consistently on this look, then I'm going to make money. And that is a big difference when it comes to the challenge algorithm. So to get as many signals, we're just not going to get as many as if we have something that's trying to predict the direction of the stock each and every day and what's it going to do based on blah, blah, blah. Right? It's a different mentality, right? And it's not a mentality that I look at as negative in any way, shape, or form. In fact, it's a very positive mentality, and it avoids a lot of disaster, right? But at the same time, it is something where if it misses a move, right? Well, let's go back to Valero, because Valero had a 3-7 crossover right here. And I got on video that day, and I said, man, I sure hope this signals, because this is a really nice 3-7 crossover. I'm not sure if it's going to signal. It could signal because it does have some semblance of a higher low, but ultimately it didn't signal. So I'm watching Valero move on higher. Man, knowing I'm not going to get a bull signal anytime soon because I need a fresh 3-7 crossover, and I'm not going to get one. Right? I'm not going to get one. I need a downside crossover first, right? So I know it's not going to come in anytime, here soon. And that's going to happen. If we had a signal that predicted, hey, what's the next direction all the time, yeah, we wouldn't miss a move like that. But we also would not miss every single one of these whipsaws, right? Every single one of these whipsaws we'd be riding painfully. And, then we grab the trend, But is that going to offset all the losses from all the whipsaws? It's just not, right? Not from an option trading standpoint. From a stock standpoint, yes. From an option trading standpoint, no. Okay, so there's going to be periods of time with the algorithm where we're going to go into we're going to go into dry periods with things, and sometimes that will happen even as the market itself moves in a big direction, right? Now, one of the things when we did back in April, when I was introducing the new challenge algorithm and how it was going to work, one of the components that we had built into it was a market vibe component, meaning we know that there are going to be times where the market makes a strong move, but it leaves us in the dust as far as trade signals because it's happened before. The market makes a big move down. We don't really have any put signals, but man, we sure wish we were on that downside. Or we have, we don't have a lot of call signals. Market's going to make a big move up. We just, because of how it's worked, we're just not going to get a lot of individual stock signals. So one component we added here, and that's been tested thoroughly and is a component that I love and will eventually come back into the challenge, is a component that trades the market vibe. That basically says, okay, when the market vibe goes from bearish to bullish, makes that move from bearish to bullish, we buy calls for the challenge on the market. And we hold those calls until the neutral signal or until it goes back to bearish. You can see that over the course of this challenge, we had a bull signal back here in the end of May, early June, right? We did not get any bear signals come in on the kind of bigger drop that came in. We had a bull signal come in on this whipsaw right here in August. And then, hey, it whipsawed back into a bear signal, whipsawed back into a bull signal. And so right now, as it sits, there would have been 4 SPY trades over the course of this challenge. This first SPY trade paid off very nicely. And it is something that, I am doing. I'm not doing it for the challenge, but I am doing it in real time because I want to continue to kind of play this system out, make sure it's functioning as intended. And this paid off very nicely. We're only in the trade for about 3 weeks, but it paid off very nicely. And then right back here in August, I got whipsawed pretty hard and lost 50% on the option. And then basically got back in here and, currently riding, SPY higher based solely on the market vibe. It was designed so that when there was periods of lack of signals, at least we're in and riding the market trend and the market move. Now, I did not add it to this challenge. Why? No, I mentioned at the beginning of this challenge, I'm going to operate this challenge, this current challenge, a little bit more conservatively. Why? Number one, because it's new, meaning it's new for the Trader Minute community and the Trader Minute members, right? And so I wanted to keep it as simple as possible, right? And so because of that, decided, no, not going to do it. Another reason I decided not to do it is because if we look at time periods when there are more whipsaws, it's over the course of the summertime period. There's just more whipsaws in the method than, in the fall, winter and spring, at least here in the U.S. So fewer whipsaws in those time periods, more whipsaws in the summer. I didn't want to have it in a period where, there's just more whipsaws. And I said, okay, we can do without it and still have a successful challenge. Right. So ultimately, it will be added back. I've decided I'm not going to add that piece back into it for the next challenge. Just because from a challenge standpoint, it's still, the algorithm, it's still in its infancy. We still have, older members coming back, returning to Trader Minute, stepping back in. I do want to keep it as simple as possible and, and continue to prove out the process, right? Prove out the process and answer the questions as they continue to, continue to come in. So overall, overall, this is a challenge where, man, I wish there were more signals, right? I wish there were more signals happening right here, right now, constantly. But at the same time, it's nothing that unusual. It's nothing that I'm going to make a massive change about. And it's something where I'll continue to show the 3-7 crossovers, right? So, today we have a Coca-Cola with a downside 3-7 crossover, and I'll continue to show them. But I do need you to realize that, hey, you know what? Only about 1 out of 3 of these actually pay off from an option standpoint. When they pay off very nicely, but they don't always pay off. Case in point, Twitter, downside 3-7 crossover yesterday. Nice gap up here today. Now, it's fading that gap here this morning, but, it is just one of those where, we saw on Pepsi, a downside 3-7 cross that was here yesterday morning. Right? Well, it reversed by the end of the day, and, the stock moving on higher here today. A 3-7 cross is the piece that we've put into it to give a trigger. But more importantly than just giving a trigger, right? More importantly than that, it's to give some validity to what we are doing, right? If I'm following somebody who's trading, right? If I'm following, the challenge, and I just see these trades coming in, and I start to look at the trades, and I go, what? There's no consistent rationale. There's no consistent basis here. I'll start to go, okay, what's going on, right? The 3-7 is added to show that consistency. There is not a single trade that has been made for the challenge that did not have a 3-7 crossover. Every single one of these trades had a 3-7 crossover. You can't find a single one that didn't, right? And you won't. And that is one of the ways that we can add that element of consistency, of technical consistency, without sharing the entire algorithm, which let's face it, we are not going to do at any time. But it is something where it does kind of show a little bit of that model of consistency with those crossovers. But, it does leave us open, right? It leaves us open, and, inevitably we get a move, right? We get a Caterpillar that moves up, and, why didn't we buy this 3-7 crossover back here? Or a Valero that moves up, and we get, why didn't we buy this 3-7 crossover back here? And, the answer is always the same, because the consolidation risk component of the challenge algorithm, wasn't in line. And, that doesn't mean the stock can't go up. Doesn't mean the stock can't go down. It doesn't say anything about what the stock could do. It just says, given this setup, it's not in our wheelhouse of probability. So we won't trade it in that case. All right. But that's all it says. When I look at Coca-Cola this morning and we see a 3-7 crossover to the upside, it's not saying, hey, this stock can't go up or down. A higher consolidation risk component is just saying the odds of a 2 average true range move higher from this exact point are just not very high, or not high enough, right? And we want that 70%, right? That's what we're looking for. If we're going to go trade options on these, I need the percentage to be high. 40% isn't good enough, right? Yeah, could ultimately that pay off? Sure could. But I want higher, right? And so if I'm pulling up a Valero and it's just not high enough, I'm not going to make the trade. No matter how much I like it, right? No matter how much I like Bank of America on the 3-7 crossover, I just can't do it. Can't get in there for the challenge. Now, the last thing I'll speak to here comes down to, a couple times in this challenge, I've stepped in and done something different than what the challenge algorithm dictates. All of it has been with current trades that are on the board. For example, Valero. It was in Valero. Something weird was going on in the market. We could see the market shifting. A new Valero. Okay, the danger here is very high. Yes, we're supposed to hold it for another day, but I'm getting out. Every time I've stepped in and done something of that nature, I think it's 3 times this challenge, it's been a good thing. We've saved some money that way, right? But each time has been to go from a period of less risk or a period of more risk to less risk. So, from a risk standpoint of basically taking it down, I've not stepped in on anything to increase the risk component. And that's going to be a tendency that will continue. I don't need to step in, right? This number 10, while all trades, entries, and exit follow the algorithm, just could step in under unusual circumstances and change a trade. I'm going to be very, very slow to step in and add risk based on something going on out there that just doesn't have to do with the challenge or the challenge algorithm. I'll be slow to step in and take off risk, but most of the times when I do step in, it will be to lower the risk, not to increase the risk. So for me to go out and take a chart or a stock like an FCX, for instance, right? Say, well, here's FCX. It's not creating a challenge signal, but we have a Dragonfly Doji here. We've had a nice retracement. I think the next move could be about 50 cents lower. Let me go and trade that. You're not going to see me do that very much at all, right? That just isn't. Yes, could I? I could. But you're not going to see that. I don't have a 3-7 crossover. I don't have the challenge justification. And I'm adding risk here, to it. And that's not what it's about. It's about having that consistency of probability of entry, knowing that it's still not good enough to avoid going to zero on challenges or to have pullbacks on challenges, but also knowing that we don't need anything super special to put sizable gains here into the challenge. So most times when I'm stepping in, or when I am making a decision that isn't 100% dictated by the challenge, I'm stepping in mostly to lower the risk component, not to raise the risk component. And, one of you keeps telling me, yeah, I'm a little too conservative this challenge, even with some of the allocations. And you're right. I have been, right? And I've admitted that several times. Been a little more conservative this challenge, right? Not on the signals. Those are auto-generated. I don't have a say or influence into those. But just in the way it's operated, some of the allocation money and all of that, I've been a little bit more conservative. Times where I've had the decision to pull the entire trade off or pull off partial, those areas, those gray areas that are still in it, that will continue to be in it. I've opted for pulling off. I've opted for less risk instead of more risk. And I've done that for many ways. I'm not trying to prove the system out to myself or anything like that, but I do have a community that is watching, following along with the system, learning the system, and I need to prove it out, and that is something that is going on here in real time, and this challenge, some will call it a failure, others will call it a success. Ultimately, I will call it a success because of the fact that, look, it has survived the chop, and the couple small trend elements that we had, it really thrived. Did it miss two big moves? Yeah, it did. It missed two big moves, and they came off of, lower lows. So those are moves I would expect to miss. Did it, avoid a lot of real bad whipsaw moves? Yeah, it sure did. Was it immune to losses? No. Did it show that it could survive a stretch of losses? Absolutely. Did it show that it could really stack in some high percentage gains on just a few wins? Yeah, absolutely. So, as I've mentioned, I expect most challenges to end, somewhere around that $10,000 mark. That's about where we're at. And, a few challenges to go to zero and a few challenges to go to 100. And I'll continue to have that expectation, and we'll continue to run it and, prove it out as we go forward. Thanks for hopping on. Have yourselves a fantastic day. I'll be back on with you here this afternoon, and we'll talk to you then. Take care.